European insurers have been a real safe haven for investors in recent years. They produce very high and very stable dividend income, despite all the challenges of low interest rates. And there's been a far more benign regulatory environment for the insurers versus the banks. From the 1st of January 2016, Solvency II is the new capital regime for European insurers, and it's really exposing a lot of volatility that's always been there but has not been clear from the solvency rules. And it's really creating some challenges for the companies in terms of managing that volatility and communicating effectively with investors. As an example, for a Dutch company, a fall in the value of a corporate bond might improve their solvency ratio, whereas under the UK interpretation, that fall in a corporate bond price would probably cause the solvency ratio to decline. This is creating real communication challenges for the insurers and also for the investors. As well as this, insurers have got liabilities to meet, which are the amounts they've promised to pay policyholders. These can be very long dated, often 30, 40, even 50 years into the future. And they often have interest rate guarantees, typically around 3%. And obviously generating that type of return, given where government bond yields in Europe are, is very challenging. With challenges on both sides of the balance sheet, assets and liabilities, we think the question for investors in Europe is whether this remains a safe haven sector.